Hi, welcome to Taxes on Bubbly. In a recent video, I discussed how CRA has been auditing the auto expenses of Canadian corporations in a big way this summer. Okay. As business owners know, auto expense is just one expense item, but we deduct their payroll expenses, travel, meals, entertainment, consulting fees that businesses also deduct, which could be subject to a CRA audit. I believe CRA audits are going to be on the rise in the near future. Okay. And CRA audits, as we know, are very expensive money-wise because it costs professional fees. It wastes your own time, and also it creates a lot of stress. But one of the other area that a failed audit costs is also extra taxes, interest, and penalties. Okay, so how does a failed audit cost extra tax? And I'm going to explain that to you here. Okay, so let's say we have a corporation who pays its shareholder, who's also a manager of the business, $1,000 a month for auto expenses. So the shareholder gets to take home $12,000 a year in auto expenses. Okay, so the shareholder gets to take that $12,000 home tax-free because it's not an income to him; it's just a reimbursement to him for the use of his personal auto for the business affairs of the corporation. And the corporation gets to deduct that $12,000 because it's an expense, right, to reimburse the car owner to use his car for the corporation business affairs. So everything is fine until, let's say, CRA comes and wants to take a look at the documentation to support that $12,000 auto expense deduction. So let's just say the documentation is not complete, as a lot of travel logs or driving logs are not complete, and CRA denies $8,000 of that auto expense and only allows $4,000. Okay. So when that happens, you see what happens is that the $8,000 that is denied gets added back to the corporation, net profit, and is taxed on it at the corporate tax level, either 11% or 27%. Okay. But that $8,000 is also added onto the income of the shareholder, and he also has to pay personal taxes on it. So in effect, you're being taxed twice. Okay? Because if that $8,000 hasn't been a reimbursement, but let's say it was paid as a salary to the shareholder, the corporation wouldn't have to pay tax on that $8,000 because salary is deductible. And the shareholder would just report as employment income, and he'll just pay personal tax on it once. So this is the extra cost of a failed tax audit: more taxes, interest on those taxes owing at the personal level and at the corporate level, and in some few instances also possible penalty on both parties. So my bottom line is, if you are going to take aggressive deductions, or there is not enough documentation to support a deduction, think twice because it could be very costly. Thanks for watching. See you on my next vlog.